Welcome to the Retirement Roadmap by SHP Financial, a podcast empowering today's retirees and pre-retirees to make well-informed financial decisions that will help you spend more time living and dreaming than worrying and wondering. Are you ready to get started? Let's go. Welcome everyone to another edition of SHP Financial's Retirement Roadmap podcast. I'm your host today, Matthew Peck. Thank you so much for lending us your ears as we dig into a very important topic that you either are painfully aware of or hear about, and that is student loans, college tuition, FAFSA, 529s, all is Pell Grants. I mean, it goes on and on in regards to this landscape of college planning, college funding, loan forgiveness, everything that you hear about. And here at SHP, we want to make sure that people are living their lives, not worrying and wondering. And there's a lot of worrying and wondering about college planning. And so the goal today is that we want to make sure that all of our listeners are better equipped to handle this landscape, to know what to do either for their kids or for their grandkids, and to truly help out the family in in a multi-generational format. Who better to discuss college planning than our own CFP, Certified Financial Planner, Certified Tax Specialist, and recurring guest on this podcast, and that's Mark Kenny.
Thanks for having me. I think it's a great topic to talk about and very relevant in today's news, so I look forward to educating our client base.
Well, especially too, I have 4 children, so I know I'm listening. I'm going to be listening to everything that you say. So I'm not sure if you want to start with the current events. I think people hear about the issues FAFSA has been having. The loan forgiveness has been a political football now since Biden was elected. First he said we're going to forgive loans, then it was struck down as unconstitutional, et cetera. Or do we just want to start at the beginning? In the sense of, all right, here are some important terms to understand when it comes to college planning.
So this is a relevant topic because statistics say there's $1.75 trillion in total student loan debt out there. So it's a talking point politically, and it's something that everyone's wondering and worrying about, unfortunately, because 42 million Americans, which is 15% of the population,
right, have
some sort of student loan debt, okay? And actually the average borrower owes $37,000. And believe it or not, Matt, when you look at the cohorts, okay, of the percentage of people, it's actually people age 62 or older that actually have the most of the student loan debt. Now, why I say that is there's more younger borrowers, but by 62, it's something like 20% of 62-year-olds have some sort of student loan debt, which is probably actually their child's or grandchild's debt.
Do we know how that got there? Was that old loans that they were never able to pay off? Or do we think it was more, these were co-signed loans and these are, and sort of just accumulate with them trying to help out their kids?
I think that's a great question. I think you got to start at the starting point of when someone decides to go to college, they have to apply for the FAFSA, okay? And
everyone applies for FAFSA or no? Or
you should, okay? Although we might not get approved for that, it kind of starts with the FAFSA to decide how much you or the student is going to pay, all right? Mm-hmm. And that usually starts every year in December for the next calendar school year. And it's done through the government website, which is studentaid.com, okay? And that determines your eligibility for financial aid. Now, you have to understand, what is the FAFSA looking at, okay? They're looking at income, and they're actually looking at income 2 years prior, all right?
And this is, sorry to interrupt, but this is a federal program. So FAFSA is, so I think I wrote down in my notes, so it's a free application for federal student aid.
That's correct.
So it's a government program, and maybe that's probably why it got kind of buggy and clunky recently. I saw that in the news.
Yeah, so there's been, they actually changed the way the FAFSA looks at income. There was a lot of bugs that went into the system. There was a lot of complaints that applications weren't getting filed on time, that birthdays were incorrect, and the whole system got backed up. making it even more frustrating for parents and students. I have read that they've kind of fixed the bugs, and it's hopefully cleaner this time around, which starts in December of 2024.
So two things there. Why December? So tell me, is that for loans for then the following spring? And then the second question is, and you were about to go there, which was, okay, what does FAFSA look at?
Yeah. It starts in December, although that's not the deadline. That's actually the earliest window that opens up.
So it begins in December.
In December for the following year. Okay. Most likely, those are people who are going to apply for the fall semester.
Okay.
So if your child's going to graduate in May or June, the window opens up this December so that you can start the application process of determining your eligibility. Now, you asked a great question. What does the FAFSA look at? It is going to look at income from the parents and assets, okay? Remember, this is a formula that's trying to gauge your ability to pay for your child. So what they do is they look at your W-2s, they look at your tax returns, and it's actually from 2 years prior. So it's almost like the what Social Security does.
For the Medicare.
For the Medicare. They look 2 years back.
Okay, 2 years previous.
I think they think, maybe you can manipulate your income the year before. So they look 2 years back. So they're obviously going to look at the income of the parents. And then they're also going to ask about assets. Like, what do you have? And I think it's important to differentiate between what is countable and what is non-countable. And I'll go through there. So obviously any liquid assets, checking, savings accounts, you have a stock account that's non-qualified, a brokerage account, real estate investments, college savings accounts, trust funds, those are all counted. And I will put a little caveat with 529 accounts. I find that it is a misbelief that parents or grandparents think that if my child has a 529 account, they are less likely to get financial aid. It's just not true, okay? In fact, the FAFSA has actually incentivized individuals to save for their child's education by putting the weighting of 529s less than these other assets. So what do I mean by that is, to put that in context, if you have a UTMA account, which we know is a minor account, you open it, you fund it with a few $1,000s every year, but it's held for the benefit of the child. That is weighted at 20%, meaning that if there's $100,000 in that account, roughly 20,000 of that is expected to go to the child's education, okay? Because technically a UTMA account is, it has a custodian, but it's for the benefit of the child. The 529, it was at 5%. I believe they even lessened the impact to there. So it's not, they're going to ask about it, but it's not something that's going to weigh heavily towards their financial aid. And I think a good point for our clients and listeners to hear is that actually 529s that are owned by the grandparent, the aunt or uncle, are not reported, okay? So, my parents, if they have a 529 for my children, when I apply for the FAFSA, that will not be counted because it's not considered my asset or my child's asset. And then other non-reportable assets, the qualified retirement plans. So if you've done a good job saving in a 401k, that is not countable. Your family home is not countable, okay? Personal possessions, and lastly, life insurance. Even the cash value of Index Universal Life is not countable on the FAFSA form.
So, all right, but Mark, I want to go back to the 529s and unpack how they're weighted against you, because there's definitely confusion there. I personally have it myself. So, okay, 529 that's in the kid's name is counted, but almost weighted. It's weighted less. Like yes, it shows up on the application, but they kind of like almost grade it on a curve. They say yes, it's there, but it's we're not going to really hold it all against you.
Yeah, that's correct. So it used to be called the expected family contribution. What the family was expected to contribute to the child's education was by a formula that looked at the income and the assets. They've since changed the terminology to student aid index. So where accounts that are held in the child's name, like UTMA accounts, private bank accounts that they may have, is weighted at 20%. The 529 is weighted at 5%, meaning that using that same $100,000, if you had $100,000 in a UTMA account, 20,000 of that is expected to go to their education, right? Where 5,000 of the 529 is expected to go if it's held in the child's name or they're the beneficiary of the 529 account.
That's interesting, yeah. And for all of our listeners, I kind of almost translate it in my mind about almost like weighted averages for grades, right? I was at my kid's student house or open house, and they're talking about, okay, tests are weighted at 50% of your grade, and homework is weighted at 15% of your grade, and 35% are quizzes or whatever that may be, or projects. And so for all of our listeners, imagine, you go through this FAFSA application, and then it sort of just enters this formula to say, okay, we're going to add more weight to that particular asset and less weight to this particular asset, or whatever that may be. And then to clarify one last point, if the 529s are not at all, if the grandparent or aunt or uncle or somebody else owns it, it's not even in this weighted average.
That's correct. Yes, that was a change. So I think the point is, yes, understanding how they come up with this student aid index, or formerly expected family contribution, and little things that you could do to maybe increase your chances of getting financial aid, like having a grandparent own the 529 account or as the custodian of that account.
Okay. So let me ask, and is now the good time to talk about co-signing loans? I hear often about co-signing loans, or should we continue with the public loans and co-signing is only really private? Because I do want to talk a little bit about private loans.
Yeah, so great question. So that's the first step, right, is filling out this FAFSA. The next step is the student can get loans on their own, okay, without any cosign. Those are called Stafford loans.
But they still have to go through FAFSA.
They
still have to develop their index or whatever.
Correct. So then what happens is on the FAFSA, I think you're allowed to put 10 different schools on there. And then depending on the cost of the school, those results will be sent to the school, which determines how much the child or parents have to pay, okay?
Okay.
And the first step is for the student to get loans in their own name. These are called Stafford loans, okay? And they're subsidized and unsubsidized, and that really just determines the amount that the student can get. Now, you'll see my notes here that, really, because the student doesn't have any income or substantial assets, the Stafford loans are only going to solve, maybe a year's worth of tuition. And that's where your point comes in, is that's where it goes to Parent Plus loans, right? We hear this term Parent Plus loans, okay? And what these are loans, federal loans, where the parent is the co-signer on these loans to come up with the cost of the tuition or room and board above and beyond the Stafford loans, okay? Now, just like any other loan, the eligibility of someone's credit and their income for the parents is going to determine how much they get for Parent Plus loans.
How much they get, or how much interest they pay? Because if they have low credit or bad credit and low income, they might be 12%, or are all these standardized?
Yeah, great question. Actually, the Parent Plus loan interest rate is set yearly, okay? And although your eligibility is determined by the underwriting of you, the parent, whether you have good income or not, the interest rate is set at, it's actually 9.08% this year, is what parents who borrow money on Parent Plus loans are going to have to pay in interest on that note.
So wait a sec. Okay, need to pause here for a little bit on this one. Number one, all of these loans that we're talking about, the first levels, like the Pell Grant or Stafford, those are federal. So you sort of start there and you get a couple chunks here and there.
Correct.
And then you realize that, okay, and what are those chunks? I mean, how much? I mean, you're talking 10,000, or how much would they get to start on their own?
Yeah,
before
so
we
a
get to the
Stafford
Parent Plus?
loan, again, the loan won't be for more than what the college costs, but we're talking about $5,500 for a subsidized Stafford loan, and up to $20,000 for a direct unsubsidized loan.
Okay, so to stop. So the max we can get from this initial tranche, if you will, this initial amount of federal student loans is, call it $20K.
Yes, that's correct. Yep.
Okay. And then current cost of college right now?
Yeah, that's what I was going to say. We were talking, I mean, depending on where you go, right? So I do have some statistics on what the average cost of college, this is just tuition now, okay? A public school is $10,740 and a private school is $38,000. Now, that is just tuition, and as we know, that runs a gamut. Some local schools here, Boston College, Boston University, are well above that. We're talking $70,000 to $80,000 all in.
Per year.
Per year, yeah. Unfortunately, that's just the cost of college. We could have another podcast on where we think that will go, whether it's worth it.
Right.
But that's technically, and that's where the Parent Plus loans come in, Matt, because if a student can only get 20 grand and BC's going, well, we want 60 grand, that's when mom and dad have to go get, if they private pay, pay cash, but if they want to get a loan, that's where the Parent Plus loans come in. And, it's important to know that they are on the hook, that's why these are underwritten, meaning that they look at the parent's income in order to provide this loan, and that they're signing up to pay these loans for 10 to 25, somewhere 30 years.
Oh, okay. So let me also, again, almost like do some quick math here, right?
Yep.
So let's say the max you get on this initial chunk is about $20K, give or take, which if we use BC's tuition is 1/8 of the total tuition, right?
Yeah.
So it'd be like 1/4 times,
not even
1/16
Yeah.
of the total tuition. And so then, okay, if we're going to make up that difference, then we move on to these Parent Plus loans.
That's correct.
Is there maximums to that, or that's just more how much debt you want to take on?
No. So again, the loan will not exceed the cost of the total cost of college.
Okay.
And actually, when these loans are delivered, I think it's important to differentiate that the Parent Plus loan will actually pay the college directly. Okay, so that you can't run off and buy a Lamborghini on it. So they will directly pay the cost of the tuition, and then any funds left over can go towards, books, room and board, computers, anything like that. But that's how they will determine, how much you borrow, and then you're on the hook to make those payments.
And as you said, it's just tuition. So if the room and board is double, if tuition's, let's say, $40K, and then room and board's another $40K, it's only the $40,000 for tuition, or does room and board get brought into the Parent
you can
Plus
borrow.
loans?
You can borrow up for the room and board.
Okay,
You can
so total
borrow
cost.
the total cost of college. And,
Okay.
and let's be honest. I mean, now with room and board, whether it's on campus or off campus, is almost the cost of tuition, right? I mean, especially if you're going to Boston, you're renting for that. So yes, you can borrow that cost in the Parent Plus loan as well.
So, okay, parent now co-signs. They say, okay, I'm going to take out $60,000 a year, whatever it may be, call it $250.
Yep.
Right? Hopefully these numbers are okay. They then, so a Parent Plus loan is an automatic co-signed loan.
Yes, has to be co-signed. That's hence the name Parent Plus loans. They have to be signed by the parents. Again, it's a higher level of debt. And we have clients that have Parent Plus loans. They could be in their 50s, 60s, 70s. Their child went to school and they're in their 30s now, and they still have this, these student loans to pay, which are quite substantial, depending on how much you borrowed.
And then when the student eventually graduates, is it a co-payment? So the student's paying half, he's getting a bill for half, and the parent's getting a bill for half?
That is a great question, Matt, and that is determined by the family, okay? So what I mean by that is, just like any other debt, right? A mortgage, you could pay my mortgage and the bank doesn't care,
right.
Okay?
Yeah.
And I'd be very thankful. But as far as student loans,
anecdotally,
as long as they're getting paid, they don't care. So who makes that payment, whether it's the parent or whether it's the student, as long as that payment is being made. However, the bill is going to come to the parents because they were the co-signer, and when they went through the underwriting process, they said, we will make these payments back to you, which can be a couple $1,000s a month. I've seen those payments.
Well, you said about 9% interest.
That's
so,
correct.
I mean, these guys are charging that. So, all right, before I get into other areas, tell us about because I'm thinking about loans and Parent Plus loans, and then as we said at the very beginning, being in the news about loan forgiveness. I mean, is this what they're talking about when they talk about loan forgiveness, Parent Plus loans, or no?
Yeah,
or is it a whole different world?
Yeah, so great question. I mean, they're talking about all student loans. As I said in the beginning, there's $1.75 trillion in total debt. And I think we're in a unique environment where COVID kind of changed everything. So during COVID, they put forbearance, they put pauses on payments, okay? But the interest started, was ticking. And obviously we've seen interest rates rise, which is, the cost of Parent Plus loans at 9%, right? We go back 3 years ago and there was mortgages at 2%. So that whole interest rate environment has changed and increased the amount of debt out there. So yes, we've seen these talking points of, because it's the elephant in the room, how can students afford to buy a house, or how can they get ahead when they're saddled with this huge amount of debt? And these payments, because they are between 10 and 30 years payments, they're almost like a mortgage.
So, but they're set every year. So it's a 30-year payment, 30-year schedule.
Yep.
Right, so like a mortgage. However, that 9% that's charged on the Parent Plus loan will vary. So it'll be 9% this year, then 10% next year, then 7%, or no? Or
it's determined when you take out the loan.
Okay,
so just like a mortgage.
It is a fixed term. It's just at that 9%.
Unless we go down the realm of consolidation, which you can consolidate loans.
Well, and so that's what I'm trying to. I'm glad you went there, because that was me. My next question was that trying to think. In general, is this how it goes? What I'm thinking is that, okay, you co-sign a loan, you take out, say, $200,000 or whatever that may be, on behalf of your son or daughter. Son or daughter then graduates. Are we then looking to kind of transfer that burden onto them because now they have a good job and that's what consolidation is, or no?
So there's two types of consolidation. First, you can consolidate within the government loans, okay? If interest rates do drop, you can consolidate those loans. They may have, a Stafford loan, they may have a couple Parent Plus loans. They can consolidate those to make, one payment to these providers, right? So we hear of Nelnet and these other providers. They're just there to collect the money. What you're talking about is if parents want to be free of that debt, right? Which I can understand, then you have to go to the private world, okay? And you have to look for private loans to pay this, this federal debt.
Government. Okay,
That's correct.
Okay.
Now, there's some pros and cons to that. The pros for the parents are, if the child has significant income or enough income to, take on this debt themselves, then yeah, you can go to Discover, SoFi, all these institutions that will say, yeah, you're credit worthy, we'll, pay them off, and it's now in the student's name. The downside is, the unknown about forgiveness on the federal loans. Private loans aren't going to be forgiven. SoFi may really like you as a customer. They're not going to forgive your loan. Where the federal government, may. This is, again, a talking point of $10,000 was going to be forgiven. And the second, and I think the morbid point that I'll make is that, if the borrower does happen to pass away, or the student, but forgive the morbidity of this, is that the loan is actually forgiven on the federal government side. So if
the Parent Plus loan?
That's correct, yeah. So if you're a parent and you sign a loan and you happen to pass away in your 60s, that debt for you and the student is forgiven on the Parent Plus loans or federal government loans. Again, on the private side, they're going to come after your estate, but for the Parent Plus loans, they are forgiven if the student or borrower does pass away.
Which then, okay, and we were talking a little bit offline, Mark, and it's like, so what type of advice do you then give your clients that have these Parent Plus loans? I mean, do you then say, okay, hey, why don't you just pay a little bit of it and then pass away, service the loan and then go ahead and enjoy that benefit? Or is it, look, hey, you're paying 9%, let's pay this off as soon as possible? I mean, how do you help your clients
specifically? How do you find that balance? Yeah, I think that's a great point. I think, again, it starts with a conversation of, is the student able to help, the child able to help in some sort of way? You see it where we'll sit down with clients in their most important job, their first financial goal is to pay off those loans. They want to pay all of it, and that's their goal. And then there's some who say, listen, I'm struggling as it is. What I'll say this is that as long as you make the minimum payment, just like a mortgage or a car loan, your credit's gonna stay intact, and eventually that loan could be forgiven or released if you were to pass away. I think from a standpoint of when I discuss with a client, I'd rather them attack any private debt that they have, mortgages, car loans, credit card debt, because that really isn't forgiven, right? And if you're coming up, if you have $3,000 and you're deciding whether to pay your mortgage or your Parent Plus loans, I'm probably going to direct you to pay your mortgage because that's a place to live. But again, I think it goes back to the beginning of understand what you're signing up for. Understand that you're going to be on the hook for these payments for 30 years, and it's probably going to be in your 60s or 70s, your retirement years, because your children are 30 years younger than you, and they're gonna that loan's on you.
And then making that decision. So let's just say, based on, so you go through the FAFSA program and the Parent Plus loan, they say, okay, you have, and it's going to cost you $80,000 a year, or whatever that may be, and so your max is, $320,000.
Yeah.
That's okay. What advice do you give to parents? Do you say, okay, let's try to loan or lend for the entire amount? Do you want to say, okay, hey, how about 25% we'll pay with income, and then 25% I'll pay with this loan, and 25% with savings? I mean, I'm just trying to think out loud of, is there a formula that you like to recommend for how much debt should the client take on, or how much of the nut should they cover through this FAFSA programs? Yeah,
there's no right answer. Like financial planning topics, right. It's an art more than a science. I think it really goes to their wishes. I think it goes to understanding what their income situation is, the parents, what their debt burden is. I have some clients that say, listen, I'll give them $10,000, each, and they have to take on the debt, the rest of it themselves. I have some clients that pay cash every semester out of their savings or their brokerage accounts. I think it starts with a conversation, but understanding the impacts of what their decision has is that, this doesn't go away. Even if there was student loan forgiveness, $10,000 with average balances of $40,000, $50,000, it's going to save you some, but it's not going to wipe away the whole debt. So I think it starts with having a conversation, putting in context how important it is for you, and then kind of goes to a deeper conversation of is college worth it?
Well, and not only that, I was going to go into another area, sort of a deeper conversation, and that's just more in the idea of legacy planning. And what I mean by that is how I'm curious, and I'll see your opinion in a moment, but I was just having this conversation with a client, right, where he was about to make a gift of a certain amount of dollars for his kids so they could put a down payment on the home. But it's like, okay, well, if one son gets $50,000, we have to make sure the other sons, get it, or it's equal out this distribution. And it's kind of similar to tuition. I mean, imagine if you have multiple kids, right? One child goes to public school and one guy goes to BC. I mean, There might be this person paid $200,000 in tuition. This other person may have paid $400,000 in tuition. Do you ever see it bleed into legacy planning, or does that conversation come up when you do have, when we are talking FAFSA?
Yeah, that comes up a lot. I mean, I'm a parent as well. You want to be fair, right? It's like when you're divvying up the M&Ms, my kids are going to count to make sure they are even. And I want to make sure that I carry that forward. I think you gotta balance it out. You don't want to send one child to Boston College, the other one goes to UMass because he wants the money for something else, put towards a business or put towards a home. So I think it is important to understand. To even it out. But you made a great point about legacy. I've had some clients that will say, listen, I put my kids through college, right? I pay $20,000, $30,000 a year. So I'm okay if they don't get $100,000 or $1 million from my IRA. You know, some clients are different. You know, they say I want to take out the minimum from my IRA because I want to leave a legacy. I think there's something to be said about giving your kids the money while you're living if you can accelerate their future instead of them getting some sort of money in 30 years. So I think the great thing about us when we run those, you know, how much money will you have at 90, 95?
Right.
If they see that they have this bucket of money, and even in the worst market conditions, there's going to be a nice legacy to be passed on, they can make a more informed decision now, which is maybe I do pay, you know, for their college education, because if they're going to get it in 30 years, but that we're going to forgo college now, you know, can't that set them up? Because we all know statistics say that, you know, you're more likely to earn more money. Although I think that's, you know, another podcast, you know, something to be said about going into the trades.
We'll come back to that big question, that you had earlier.
You know, but that allows them to make an informed decision instead of getting, you know, when they're 95 and the child's 65, and all of a sudden, you know, they didn't go to college or the parents didn't give them, you know, a gift to buy a home. You know, what good is the money at 65 when you could have had it in your 20s or 30s and set you up for a better future?
Yeah, especially at that time and time value of money when you receive the funds versus the future. Well, and the last thing, just to kind of bring it back into college planning and FAFSAs and 529s, the FAFSA program that we're talking about is for parents. Is that correct?
Yeah. So, I mean, it's for parents and students. You have to apply both.
Well, the reason why I was asking is because if it's primarily parent-based, and some of our listeners are grandparents.
Yeah.
What recommendation would you give to them? Is it the 529 route, or what? So let's say there's a grandparent listening right now. Say, okay, well, my son and daughter have to navigate it for my grandkids. Here's how I would like to help, or what ways can they help?
Okay, so I'll tell you the things that they shouldn't do. Okay,
That's good stuff.
Is give money to the child outright. Okay. Do not give $20,000 to little Johnny so he can put in his savings accounts, because again, we go back to the beginning, is that is more heavily weighted. Grandparents have a unique situation where they can pay directly to the school if they want. Okay, they can actually use a 529 account, and in order to avoid the gifting limit, grandparents, or actually anyone, can give 5 years worth of gifting into a 529 in one lump sum. So what I mean by that is that they want to really help out, right? So $18,000 is the annual gift limit, I believe, this year. So 5 years of $18,000, what's that, $90,000, a grandparent can put into a 529 account, okay, today. That money can grow. You know, we invest the accounts, and that can be used for the grandchild's college tuition or expenses. Again, it's not counted on the FAFSA because the grandparent is the custodian of that account. And they just said, you know, listen, we just took money that little Johnny will get in 20 years, 30 years, and we're giving it to him now, okay? They could, you know, if they wanted to pay cash to the institution, I just want them to avoid giving money directly to their child, which would be the parents, or to the grandchild, to jeopardize their financial aid.
And sorry, one last point just to clarify. They can pay directly to the college?
Of course.
So is that a gift or not a gift, or what is that?
It's considered a gift.
It is considered a gift, okay.
Although
so
they're
still subject to those 18,000.
Yeah, but remember gift splitting, 36,000 for families,
right.
And you know, they're a lot more lenient on debt going to students, tuition, than they are to you know, buying them a car as far as the gifting limit is concerned. So yeah, they can fund the 529, you know, with up to 180,000 per you know, two people. And remember the flexibility of the 529 too, not to be lost. If that child doesn't use the money, the custodian, the grandparent, can change the beneficiary to another child that's going to use it, or, you know, they can use it for some sort of other, I know we talked about, you know, rolling that over to a Roth IRA. That's allowed now under the new rules. Or, you know, yes, there is a 10% penalty on funds that aren't used for qualified expenses, but it's taxed at, you know, it's taxed at 10%, and then the gains are taxed to the child, which usually doesn't have high incomes at that point. As
mentioned, usually we talked about the high cost of the tuition, plus the Roth contributions. That'd be plus the fact that you can change the beneficiaries of the 529s. It's
That's
very,
correct.
very I'm not with all the costs, everything we talked about. I'm not very concerned, especially with the new Roth rule, where you can roll it into the Roth, that there'll be money left over in the 529, or that unless it's an emergency of emergencies, meaning that most likely you wouldn't have to pay that 10% excise tax, because you'd be able. There's all these different valves or exits that you can take.
$10,000 now can be used for student loan debt.
Interesting.
They opened that up, and $10,000 a year can be used for private high schools. So again, it goes back to they're expanding the options available to 529 accounts to incentivize parents, grandparents to save for college.
Excellent. Well, all right. Now I have the most important question. What's your favorite college movie?
Oh man,
yeah,
there's a lot of them. I gotta stick to at home and go with Good Will Hunting.
Oh, all right.
I mean, actually, it just happened to be on the other day, and I rewatched it again, and just the incredible movie, and the fact that those guys wrote it makes it even better. And it's Boston.
I just didn't know if you're going to do Animal House or Old School or PCU or Road Trip or
there's a lot of good ones. We'll stick with Good Will Hunting.
All right, I think it's a safe bet. So, Mark, thanks again so much for coming on.
Thanks for having me.
Hopefully all of our listeners found it very informative. I know I did for sure. And you can tell there's just so much there, not just in the program itself and all the mechanics and how it works, but how it bleeds into and brings up bigger questions like legacy planning. Like, okay, if I'm doing college planning, well, guess what? That has an impact on legacy planning. And should I gift things now while they are alive, or should I wait? It goes into income planning. How much debt can I afford at this point in time? And so it's just we talk about making sure people aren't worrying and wondering, and these are the types of issues that people worry and wonder about, whether you're a parent or a grandparent. And I really hope that people found it informative and helpful, as they navigate this very pricey, landscape. So thanks again for listening, everyone, and be well. Thanks for listening to the Retirement Roadmap Podcast by SHP Financial. If you've enjoyed today's episode, be sure to hit the subscribe button so future episodes are automatically downloaded directly to your device. And if you've liked what you heard, please share the show. Create your own little ripples so we can help even more people with their retirement goals. If you want access to all past interviews, including notes, resources, and exclusive content from SHP Financial, visit shpfinancial.com/podcast. Thanks again for joining us on the Retirement Roadmap Podcast. And for all the attorneys out there and disclaimers and disclosures, I'm just going to put on my super serious voice and add our own. No statements made during the Retirement Roadmap Podcast shall constitute tax, legal, or accounting advice. You should consult your own legal or tax professional on any such matters. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Our investment advisory services are offered through SHP Wealth Management, LLC, an SEC-registered investment advisor. Insurance sales are offered through SHP Financial, LLC. Our advisors and insurance reps may offer clients advice and/or products from each entity. No client is under any obligation to purchase any insurance product.